Côte d'Ivoire and Ghana grow 60% of the world's cocoa. That cocoa feeds a chocolate industry worth over $100 billion a year. But the farmers who grow it keep roughly 5% of that value. Between 73 and 90% of them never earn a living income, and up to 58% survive below the World Bank's extreme poverty line. Here is where it breaks apart. In early 2024, cocoa futures exploded past $12,000 per metric ton, the highest price ever recorded. And by early 2026, those same futures had crashed 50%, back to between $3,000 and $5,000. None of that created wealth for the people growing the crop. What it did was destroy institutional systems that had been running for over 3 decades, strand 200,000 tons of physical cocoa at Ivorian ports, leave nearly 1 million Ghanaian farmers entirely unpaid, and collapse Ghana's 32-year sovereign financing model in a matter of weeks. The machine that runs on cocoa. Before any of this makes sense, you need to understand the machinery these two countries engineered to manage their most important export. Ghana and Côte d'Ivoire built completely different systems, but both share the same fatal design flaw. They absorb global price volatility at the state level, so farmers never feel it directly. And that works fine until the volatility becomes extreme enough to destroy the state itself. Ghana runs the entire sector through a state monopoly called COCOBOD, the Ghana Cocoa Board. Every October, a multi-stakeholder body called the Producer Price Review Committee locks in a fixed, non-negotiable farm gate price for the whole season, targeting roughly 70% of the gross free on-board export value back to producers. Private licensed buying companies fan out into rural districts, purchase beans at exactly the gazetted price, haul them to state takeover points, and collect reimbursement plus a guaranteed margin for their trouble. These LBCs carry zero international price risk. A wholly owned COCOBOD subsidiary, called the Cocoa Marketing Company, controls every final export sale to multinational buyers. Côte d'Ivoire took a different route, and the reason tells you everything about how dangerous cocoa can be. Full market liberalization in the 1990s contributed directly to a civil war lasting from 2002 to 2011, which meant the post-war government rebuilt the sector under a hybrid regulator called the Conseil du Café Cacao, or the CCC. Twice a day, the CCC runs electronic forward auctions, selling 70 to 80% of the anticipated crop to authorized multinational exporters like Cargill, Olam, and Barry Callebaut, up to a full year before the harvest. The average clearing price across those auctions then sets the guaranteed minimum farm gate price for October, and that commitment is locked in regardless of where global markets move afterward. Both systems strap the state into rigid pricing obligations, and that rigidity turns lethal when prices swing violently in either direction. The boom that never reached the farmer. Late 2023 delivered a cascade of biological and climatic destruction across the West African cocoa belt. Torrential, unseasonal rainfall triggered aggressive outbreaks of black pod disease, and that excessive moisture gave way almost immediately to severe harmattan winds and prolonged drought. Layered on top of all of it, an incurable pathogen called cocoa swollen shoot virus disease had already destroyed an estimated 500,000 hectares of productive land in Ghana alone. Climate change had added up to 6 additional weeks of days exceeding 32 degrees Celsius, a temperature threshold that directly damages cocoa tree physiology across 71% of the region's producing areas. Harvest numbers came in catastrophically short. Côte d'Ivoire's production dropped 24% to 1.76 million metric tons, while Ghana's output collapsed to just 432,145 tons, against an official projection of 800,000, a 45% shortfall. Analysts estimated the global physical supply deficit at 490,000 tons for the 2023/2024 season, and that legitimate shortage became a magnet for speculative capital. Hedge funds, algorithmic trading systems, and momentum money poured into the futures market. The stock-to-grind ratio cratered to a 46-year low of 27%, and ICE New York. Cocoa futures gained over 165% in a single calendar year, hitting $12,605 per metric ton by April 2024. And here is the paradox at the center of this entire crisis. Because COCOBOD and the CCC had already sold 70 to 80% of their anticipated crops forward to hedge against downside risk, neither government could capitalize on the spike. The upside belonged to the speculators, not the producers. Ghana's forward contracts had been locked at an average of $2,661 per ton, which meant that when spot prices topped $10,000, COCOBOD sat paralyzed, unable to sell into the rally. What made it worse was that the harvest physically fell short of the contracted volumes, forcing COCOBOD to roll over more than 333,767 tons into future seasons and absorb financial losses exceeding $1 billion. A price boom that was supposed to rescue West African farmers ended up producing the single worst financial loss in the history of Ghanaian cocoa: the crash. The speculative bubble broke the way they always break, from the demand side. Retail consumers worldwide pushed back against inflated chocolate prices, and the old assumption that chocolate demand stayed inelastic no matter what turned out to be wrong. European chocolate demand elasticity lurched from a traditional 0.4 all the way out to between 0.7 and 0.8, as cumulative retail price increases exceeding 30% finally hit the limit of what consumers would absorb. Industrial grindings data captured the damage in exact numbers. European grindings dropped 8.3% year over year to 304,470 metric tons, marking the lowest fourth-quarter volume in 12 years, while Asian grindings fell 4.8%. Barry Callebaut, the world's largest bulk chocolate processor, reported a 22% collapse in global cocoa sales volume. Hershey saw an 18% decline in volume and product mix that dragged net sales down 15.2%. And Mondelez International took a 5.7% hit to physical chocolate volumes, alongside a crushing 580 basis point compression in gross profit margins. Once those demand destruction numbers hit, speculative capital evacuated the futures market as violently as it had arrived, driving prices down to between $3,000 and $5,000 per ton by early 2026. What followed was a toxic standoff where physical buyers, watching futures plummet, flatly refused to honor the high state-mandated prices in West Africa. Anatomy of the 2026 meltdown. February 2026 delivered the worst-case convergence: plummeting global futures, inflexible state pricing, and a financing system that had already cracked, all collapsing into each other simultaneously across the West African supply chain. Ghana's crisis landed as a total liquidity freeze. COCOBOD failed to secure its annual offshore syndicated loan for the first time since 1992, and the scale of what vanished is difficult to overstate. Over 31 consecutive years, this single facility had channeled more than $28 billion into the Ghanaian economy, routinely exceeding $1.3 billion per season, making it the largest soft commodity deal anywhere in sub-Saharan Africa. When the harvest came up short and COCOBOD could not physically deliver on its forward contracts, international lenders walked away, and 3 decades of sovereign agricultural financing evaporated. License-buying companies scrambled to secure independent capital at punishing domestic interest rates, and ended up piling on between $650 million and $750 million in debt to Ghanaian commercial banks. Farmers who had delivered cocoa between November 2025 and February 2026 received nothing, and arrears exceeded 10 billion cedis across the country. 70,000 metric tons of harvested beans sat rotting in rural fields, and LBCs waited for state reimbursement on 580,000 tons already delivered to government warehouses. On February 12, 2026, Ghana's finance minister announced a 28.6% mid-season price cut, slashing the guaranteed farm gate rate from 58,000 cedis per ton to 41,392, which works out to 2,587 cedis per 64-kilogram bag. Surveys had already shown that 78% of cocoa farmers could not cover basic household expenses if prices dropped by just 25%. Ghana cut by nearly 29. Across the border, Côte d'Ivoire faced a different kind of breakdown. The CCC had locked in a main crop farm gate price of 2,800 CFA francs per kilogram in October 2025, betting on sustained high prices. When the global crash arrived, multinational exporters operating under the GEPEX Association, names like Cargill, Olam, and Barry Callebaut, stopped buying entirely because completing their contracts meant accepting massive negative margins. 200,000 metric tons of main crop cocoa accumulated inland and at ports with no buyer to take them. The Ivorian state pledged a $500 million emergency bailout to purchase 100,000 tons directly, and then reclassified the season to drop prices from 2,800 to between 800 and 1,000 CFA francs per kilogram. That amounts to a 65% income destruction for Ivorian smallholders. Cocoa bonds and the sovereign gamble. With the offshore syndicated loan model dead, Ghana's government reached for something that had never been tried before: domestic cedi-denominated cocoa bonds. Under this redesigned architecture, Cocoa Bod cuts itself off from offshore dollar syndication entirely and raises capital from the domestic financial market to build a continuous revolving fund. The problem was that Cocoa Bod's balance sheet had already been gutted. Core legacy debts totaled roughly 5 billion cedis, split between 3.7 billion owed to the Ministry of Finance and 1.38 billion owed to the Bank of Ghana. On top of that, the agency had accumulated 21.7 billion cedis in unregulated cocoa road construction contracts that had to be negotiated down to 4.35 billion and transferred to the Ministry of Roads just to stave off immediate insolvency. Making the new cocoa bonds attractive to domestic investors posed its own challenge, because many of those investors had been burned badly by the 2022 Domestic Debt Exchange Program, where bondholders absorbed severe haircuts. To restore confidence, the cabinet directed the Ministry of Finance to seek parliamentary approval for converting 5.8 billion cedis of Cocoa Bod's legacy debt, the 3.7 billion owed to the Finance Ministry and the 1.38 billion owed to the central bank, directly into equity, effectively writing it off to put positive numbers back on Cocoa Bod's balance sheet. Analysts expect domestic investors to demand punishing risk premiums, pricing the cocoa bonds well above standard government treasury bills. Over the next 12 to 18 months, the restructuring probability assigned to COCOBOD sits at 60 to 70%. For indigenous license buying companies, the probability of outright default ranges between 75 and 85%. The human wreckage. When rural households lose their income, what follows is measurable and permanent. Across Ghana and Côte d'Ivoire, over 2.1 million children work in cocoa production. In Ghanaian cocoa-producing households, the figure reaches 66.8% of all children directly involved in agricultural labor. What happens during a liquidity crisis is that farmers cannot afford to hire adult workers, which means unpaid family labor fills the gap. Children end up clearing forests with machetes, applying toxic agrochemicals without protective equipment, and hauling cocoa sacks that weigh over 100 pounds. The exposure rate to agricultural chemicals among these children has surged from 15% to nearly 50% over the past decade. Roughly 30% of children working on Ivorian cocoa farms have no access to formal education at all. This exact pattern has played out before. In 1990, the Ivorian government slashed cocoa prices by 50% in a structural adjustment, and school enrollment among cocoa-producing households collapsed immediately. Enrollment for boys dropped over 4.45%, girls fell nearly 6%, and children born or raised during that shock showed reduced height stature and increased morbidity, confirming that economic shocks during early childhood inflict irreversible developmental damage. What makes 2026 structurally worse than 1990 is the macroeconomic backdrop. The 1990 cut happened under a stable currency peg and relatively low inflation, while today's income shock stacks on top of hyperinflation, rapid currency depreciation, and existing sovereign debt crises. Daily income for cocoa farmers ranges between 50 cents and $1.25. 6% of a chocolate bar's final retail value reaches the farmer who grew its main ingredient. Even doubling the farm gate price would not solve it, because structural agronomic barriers, including fragmented land holdings and yields, stuck at around 300 kilograms per hectare, ensure that up to 65% of households would still fall short of the living income benchmark. Sharecroppers sit at the absolute bottom, earning an average of €953 per year, while the established living income benchmark stands at 4,770, meaning 100% of that demographic lives below it. The three structural breaks. Three forces are converging underneath this crisis that guarantee it will not resolve the way previous downturns have. This one is permanent. The first is biological collapse. West African tree stock is aging rapidly, with a large share of trees having exceeded their 25-year optimal yielding lifespan, and the cocoa swollen shoot virus disease spreading through plantations has no chemical cure. Infected trees must be completely uprooted and burned, followed by replanting that takes 3 to 5 years before a single productive harvest. CSSVD infects an estimated 31% of all cocoa growing land in Ghana, and roughly 15% in Côte d'Ivoire. Compounding the damage, illegal artisanal gold mining called galamsey keeps permanently destroying arable farmland across Ghana, contaminating soil and water tables with mercury and cyanide. The second is regulatory transformation on a scale the industry has never faced. The European Union deforestation regulation demands that any cocoa entering Europe carry precise GPS coordinates, linking it to the exact plot of land where it grew, with proof that no deforestation occurred after December 31st, 2020. 80% of West African cocoa comes from millions of unmapped smallholders operating in informal networks, and as of 2023, only 22% of indirect cocoa supply could be traced to the farm level. Non-compliance carries absolute market exclusion from Europe, and penalties reaching 4% of a company's total EU turnover. The third is hyper-financialization. Cocoa has permanently crossed from a physical hedging arena into a speculative asset class that global macro funds trade for momentum. Early 2026 brought cocoa futures into the Bloomberg Commodity Index, a structural addition modeled to attract up to $2 billion in passive institutional buying. Paper market liquidity now overwhelms physical fundamentals, pushing prices to irrational highs and then ripping them back down when algorithmic capital decides to exit. What comes next? The 2016-2017 cocoa crisis followed the textbook pattern. Overproduction flooded the market, prices fell, demand eventually absorbed the surplus, and equilibrium returned. 2026 does not follow that pattern. The physical limits of the West African producing basin have been breached by disease and climate, and the financial architecture engineered in the 1990s cannot handle the speed of modern derivative capital flows. Quantitative models point to a medium-term price equilibrium around $6,000 per metric ton. Longer-range forecasts extending toward the end of the decade flag a potential return to $10,000 to $14,000 as climate risks, structural underinvestment, and compliance costs compound. Latin America is not waiting for West Africa to recover. Ecuador, running agroforestry systems with average yields of 800 kilograms per hectare, more than double the West African average. Projects over 570,000 tons for the 2025/2026 season, with targets past 650,000 tons by 2027. Ecuador is positioning itself to permanently displace Ghana as the world's second-largest cocoa producer. Downstream, manufacturers are reformulating to cut their dependence on cocoa entirely. Barry Callebaut has roughly 600 compound research and development projects running, and is rolling out Choviva, a chocolate alternative made without any cocoa at all. Shrinkflation and the replacement of cocoa butter with cheaper vegetable fats are accelerating across the retail shelf. If consumers permanently settle into lower cocoa intensity products, the equilibrium demand for West African cocoa may never return to pre-2023 levels. $100 billion flows through the global chocolate industry every year. The farmers who make it possible earn between 50 cents and $1.25 a day. A $400 per ton living income differential was introduced in 2020 to address that gap, and it became meaningless when futures contracts started swinging by $5,000 to $8,000 per ton inside a single quarter. Structurally cheap, abundant West African cocoa is gone. Biological constraints, aging farmer demographics, and massive regulatory compliance costs lock in severe supply fragility for years to come. Without a complete restructuring of how value moves across this supply chain, the system will keep cycling between speculative bubbles and sovereign collapses. And the people at the very bottom, the ones who actually grow the cocoa, will keep absorbing the full weight of every single crash.